Thank you for the invitation to be here. Thank you for that introduction, and it truly is my pleasure to be here. I was pleased to be here for your address, Leanne. I want to acknowledge the success that you've had and the leadership that you're bringing to your broken city, as you say, soon to be the newest city in the world. I believe Leanne's the right person for that job, appointed at the right time. And it's absolutely clear that your city agrees because you've got such an enormous mandate. If I ever won an election like that, I'd be very pleased. I've never had a win like that in my life. We look forward to working closely with you, Leanne, and your team as the recovery unfolds. Can I also acknowledge the leaders of the insurance industry that are here? I see IAG sitting here in the front row, and others who I've met previously. Can I thank you for your contribution to the recovery? I believe the insurance industry has stepped up to the challenges that are facing Canterbury and that it's doing its best to settle claims in order for people to move on with their lives. It would, of course, be ridiculous to suggest that there have not been problems. Of course there have been. You can't avoid them in an event like this. Some people have been pushed from pillar to post, being subject to far more inspections, assessments, re-inspections and reassessments than seems reasonable, and the prolonged uncertainty and disruption is very frustrating for them. I know that the causes of the delay are sometimes complex, including the legal wrangle between EQC and other insurers as to whether EQC was liable for its layer of cover only once or had additional liability for later events. I hope that in the future a more practical method can be devised for settling EQC and private insurer layers of cover through a single process. This is something that Leanne Dalziel has previously suggested through some delegation of settlement functions, perhaps by EQC to the private insurer, or perhaps working both ways, backed by letters of comfort or undertakings from the Crown to honour the decisions that are made. I'm frustrated in a similar way to Leanne that where there are disputes, there's no practical, affordable and timely route to resolve them through the courts. I agree it's likely that some test cases are needed. Where they are, in my view, they should be fully funded by the Crown and expedited. The proper place for resolving these is in the courts. Precedents are sometimes needed rather than compromises. This is a symptom in terms of problems and litigation of a broader problem which extends beyond insurance. I'm a former civil litigation partner in a major South Island law firm, and I am absolutely certain that the complexity, delay and cost of civil court processes has become intolerable. Indeed, it's one of the reasons why I gave up civil litigation. I didn't believe that the level of bills that were required to be sent because of complexity of process were justified by the amounts that were an issue. And it actually drove me in substantial part from my practice as a lawyer. Too often, civil court processes are now a barrier to resolving disputes through the courts. This means the courts do not meet their societal aim, which is to provide a just mechanism for resolving disputes. It's frustrating and costly for all involved. This feeds the viewpoint that some insurers string out processes in order to delay and put pressure on the insured claimant to settle. As I said, this is a wider problem than just in the insurance industry. We have as close to perfect outcomes as can be achieved in any system for those litigants who can afford to and do run the marathon of civil processes. Most lawyers and judges are perfectionists. We want to achieve the perfect outcome. But for perfection of outcome, in my view, is getting in the way of access to justice. And I know that justice delayed, or justice which is too expensive to access, is in fact justice denied. I'm the Shadow Attorney General. The rules of court in a constitutional sense are promulgated by the Attorney General. And I want to work with the Law Society and judges and others in civil society, including insurers, to reform civil processes so the courts really can fulfil their function, which is a rational civil way of settling disputes rather than fisticuffs or unresolved disputes. Returning to Canterbury earthquake claims on the whole, I feel the industry has responded well. The ability to insure against risk, is vital to the effective functioning of any modern economy, any modern society. And I think Christchurch has brought home to the vast majority of New Zealanders the importance of having fair and affordable access to adequate insurance company. Indeed, we're lucky that we're one of the best insured countries in the world. As you're aware, insurers and reinsurers are going to pay out around $20 billion under policy arrangements triggered by the Canterbury earthquakes. The government, the taxpayer, will contribute about 15, and the total cost of the rebuild is currently estimated around $40 billion. Weekend before last, my party held its annual conference in Christchurch. Ordinarily, such an event would largely have gone unnoticed by many of you. But the announcement that a Labour government will set up a Kiwibank-style general insurance company has, of course, put a bit of ginger into this address today. Kiwi Assure will provide a significant locally owned alternative and further sharpen competition in the market. We'll offer home, contents and vehicle insurance, along with cover for small business plant and equipment. It will enable Kiwibank and New Zealand Post to maintain the broad level of service that they want to provide in our communities, despite a decrease in postal volumes, which is decreasing the size of their post business, as is shown by their large number of redundancies recently. KiwiSure will offer New Zealand families an alternative that they will share a stake in. Subject to a business case, it will be a sister company of Kiwibank and will evolve out of the existing Kiwi Insurance Limited, which is one of the New Zealand Post group of companies. The response from the public has been encouraging, not so the insurance industries and our political opponents. The Insurance Council, speaking on behalf of the industry, called Kiwi Assure ill-conceived, back to the future, and raised the spectre of, quotes, manipulating premiums for political purposes, none of which, I would note, has occurred with Kiwibank. However, behind the hyperbole was a fair concern that a state-owned insurer would place the taxpayer at risk of incurring losses, including losses from natural disasters. I would note that Kiwi Assure will operate under the same prudential regime administered by the Reserve Bank as its competitors. It will access the international reinsurance market in order to limit its exposure. Premiums will be competitive and commercially priced, and there will be no government guarantee. It will be well placed to spread geographic risk within New Zealand, given the reach of New Zealand Post and Kiwibank, and of all the criticisms that were made of it, I thought that was the most spurious, to be honest. The experience of Kiwibank with 800,000 customers shows there is indeed a market for a domestic insurer, giving people the choice to do business with a company that keeps its profits in New Zealand. Time will tell. The big banks, of course, are relaxed about competing with Kiwibank. I think it's got about 10% of personal current accounts in New Zealand, so it has been a success, and it made a profit last year of about $100 million, but it certainly hasn't threatened the dominance of the Australian banks. And I'm equally sure that you'll be able to compete with Kiwi Assure. I want to move to and I'm happy to talk about that later if you've got questions. I want to move to another issue which I think is worthy of more discussion, which is whether we should move in New Zealand to a prudential requirement of a 1 in 1,000 year event rather than a 1 in 500 year event. And this is an issue that's been raised with me by a number of senior figures in your industry. I'm convinced that they do so from a position of New Zealand's best interests. Indeed, they can live with either eventuality, so I'm sure that's the case. For me, we need to be very careful with this. I have a concern that the first consequence of a higher capital requirement for an insurer might be that the capital is not available to them. The multinationals that are present in New Zealand compete for capital into the different companies they own around the world. The New Zealand arm of the multinational will be competing for capital amongst its sister or brother organisations in different parts of the world. And they may well find it difficult to get the additional capital to put into the New Zealand operation. And the parent company might choose, on balance, given our risks and our small market, to withdraw from the market instead of stropping up with the extra capital. Or stumping up with the extra capital would be a better phrase. This would mean that we would have less competition in New Zealand, and it would also mean we would be becoming even more reliant on the remaining insurers concentrating risk in the event of another large event. The second issue is that even if they can get the additional capital in New Zealand to meet a higher prudential ratio, The cost of that increased capital would be passed on to the people who buy insurance. In other words, people's insurance premiums would go up. Then some of those people who would otherwise have taken insurance will not take insurance or will take lower levels of cover. In terms of the effect on New Zealand's insurance cover, it's conceivable that increasing the capital requirements could actually result in lower levels of insurance in New Zealand. So it could be counterproductive if what we're trying to do is minimise the risk of consequences in New Zealand if there is another really bad earthquake, or one even worse, let's say the main fault in the South Island let go. I'm not saying it would be an inevitable outcome, but I think that this requires careful analysis. Should fewer people insure against different sorts of risk, be they domestic or commercial, and we have insurance costs going up even more than they already are, then we could actually have the opposite outcome to that which we intend. So even though the Reserve Bank might be thinking that it's improving from its perspective the financial stability of the insurance companies, overall New Zealand might be worse off because we have lower levels of insurance. The third area of relevant concern is the effect on competition of new entrants with our large players. Over the last 2 or 3 decades, we've seen a concentration of ownership by overseas multinationals of New Zealand's insurance market. This is also something that's happened in other parts of the financial services sector, like the banking industry. As a consequence of, amongst other things, our monetary policy settings and our savings and tax settings, New Zealand has been hollowed out when it comes to ownership of a lot of our assets, including in our financial services sector. And if you've got any doubt about that, reflect on the fact that over recent decades, those clever Australians, because they save better and they've got better industry settings, including tax settings, they own their own financial services sector and ours. Now, the ability of small New Zealand companies to start up and grow into companies that compete with these overseas companies could be inhibited by increasing stringency of capital requirements that make it harder for new entrants to enter into the new market and compete. So settling on appropriate prudential capital ratios is a matter that needs wider discussion, in my view, and a more holistic analysis before the decisions are made. I want to take the opportunity of having you as a captive audience to address some wider economic issues which I believe confront the nation. I'm personally convinced that unless we grow the breadth and depth of our exports, we're never going to pay for the cost of our imports and interest, and we will continue with our lamentable record of 30 years of current account deficits, which has led to New Zealand having amongst the highest net international liabilities in the developed world. It's not government liabilities, it's net international liabilities, a small fraction of which is government, most of which is private. I believe overcoming this problem is New Zealand's greatest economic challenge. While our government debt has just hit 60 billion, net debt was 0 5 years ago, the books are heading back to surplus, which Labour supports. We should know a thing or two about running surpluses and the importance of doing so. Every year we were in government, we ran a surplus. In fact, we ran 9 surpluses in a row, one every year. Some enormous surpluses when it was a time of plenty. We really did put money away for a rainy day. So we do know a thing or two about fiscal responsibility. We know we can't write cheques, we can't cash. And indeed, my own upbringing in Southern Presbyterian roots make me naturally careful with the public purse. Yet according to the IMF, New Zealand had the highest external deficit in the developed world last year, worse than Greece. That sorry state of affairs is predicted to continue not just this year, but for the next 3 years, to the end of the projection period, our external deficit is predicted to be worst in the developed world. We've been living beyond our means for decades. Unless we fix this, we'll own less and less of our own country. We'll be making more and more payments to external creditors and owners of New Zealand businesses, and our younger New Zealanders will have fewer opportunities to prosper in our own country. In my opinion, we need to do more than talk about rebalancing the economy to ensure the more high-value exports and new jobs we need. To put it in sort of in a one sentence, in my opinion, we need to move as a country from volume to value. The solutions are complex, otherwise this would have been fixed ages ago. But I want to, before I go into them, just reflect on where we've come from as a country over the last 3 decades. If you go back to the 1970s, governments around the world were grappling with an energy crisis and inflation. New Zealand made some very poor decisions back then. It's hard to believe back then we had carless days. The government was telling people by statutory regulation when they couldn't use their car. We had those ill-fated carless days. And I mention this to young people, they can't conceive how draconian that is and that a government would inflict that upon New Zealanders. And it always amuses me when our opponents trot out images of Labour standing for a command or economy or references to Polish shipyards when we propose what we believe are progressive policy solutions, given it was their party that did this to New Zealand at the time. Anyway, by 1983, New Zealand had had double-digit inflation for running for a decade, more than a decade. Wages had failed to keep pace, and in response, the then government of the day, and again I have to say national, brought down a ridiculous wage and price freeze. Of course it failed. The economy stalled, the government's position was in free fall, there was a run on the currency, interest rates on home loans shot up and reached 20% by the mid-80s. The efforts of Reserve Bank to rein in inflation were formalised by the late 1980s when the Reserve Bank under Labour was given independence and told to focus on inflation, give dominance to inflation targeting. By then, we'd been suffering from high and erratic inflation averaging 10 to 15% for close to 2 decades. As I said, Reserve Bank was given independence, a mandate to pursue price stability, and the pursuit of inflation was, they really tackled it. And they tackled it effectively. By the end of the 1990s, low inflation had been achieved, albeit at some cost to parts of society, and it has since become a well-entrenched feature of our landscape. Now, the importance of controlling inflation is a lesson of history well learned, and I and the Labour Party remain committed to an independent full-service Reserve Bank. I mention this history to remind us, when I talk about the need to address the exchange rate, not to forget that the exchange rate is not the only economic setting that hurts the tradable export sector, because high inflation, especially in the absence of a capital gains tax, encourages speculative investment into asset classes like land to the detriment of investment flows into capital equipment. High interest rates associated with high inflation also increase the cost of investing in capital plant, which we all know is needed to improve productivity and maintain export competitiveness. However, while the crippling effect of high and volatile inflation is uncontested, it is at the very least arguable that New Zealand's prescription of monetary policy was applied in too draconian a fashion in terms of how high interest rates were pushed, and in too lax a fashion in terms of credit flows into New Zealand, which fed some of the consumption pressures that higher interest rates were meant to curb. We do have a tendency for policy extremes in New Zealand. Other countries achieved control of inflation without interest rates staying higher than international averages over time. Ours still are. The international trend was for lower inflation over this period anyway, and some inflationary pressures would have abated even without the Reserve Bank Act. So while the success of the Reserve Bank Act is pretty clear, low and stable inflation, it's important that we're not blind to the limits and side effects of monetary policy and reflect on ways we could do better. And it shouldn't blind us into ways that we can rationally deal with our world-leading external deficit. And being world-leading on this one is not a good thing. In the 1980s, we also started our infrastructure deficit because governments at the time faced with this enormous debt load, $1.05 of taxes was being spent on interest, and because of the enormous deficit that was compounding upwards. And governments subsequently, for 20 years, had to get the government balance sheet back under control. They still had to fund their nurses and doctors, their teachers, their police, superannuation, unemployment benefits to the people caught up in the changes. But the one thing they could avoid or delay was capital expenditure on infrastructure, and they did. And they were right to do so, but as a consequence, we fell behind on our infrastructure spend. Now, if you get too far behind on infrastructure spend, it causes problems in the wider economy because infrastructure has an importance beyond the centre of business. It has effects on the efficiency of the wider economy. So the last Labour government, we really turned the tap on, and the current government has continued that as well. And as a consequence, we have now largely caught up on that infrastructure deficit. We've had new skills in hospitals from from Bluff to the far north, we've had these enormous roading projects in Auckland at last being able to be funded. We've had rail expenditure, we've had telecommunications. The current government's got us cracking on broadband. We really have made progress. We've had not just telecommunications, we've had generation expenditure so that we've now got an electricity generation surplus. We've had these enormous transmission upgrades. We had really ropey transmission problem keeping the lights on in Auckland, and now we've done those enormous upgrades that won't need to be done for another generation again, if ever, given changing technology. So central government capital expenditure in the last decade has risen to amongst the highest in the OECD for about a decade now. So in Labour, I think we're reflecting on this question is now that we've done that, it's proper to ask where best to direct the substantial government contribution that government makes to influence capital expenditure. And in my view, it's time for the government to focus more on stimulating industrial capital expenditure following that period of necessary and expensive catch-up on CapEx on infrastructure. Now, this isn't to deny the need for more CapEx on infrastructure. There will still be some more. Christchurch is an obvious example. City rail loops, another example up here. So continued investment in all areas of infrastructure will always be required. But on balance, we can now shift the focus away from that catch-up on infrastructure and put it towards industrial CapEx. And the Labour Party has a policy mix which proposes to do that as part of our drive towards promoting investment in the productive economy and growth. So, what are we about? Well, we say we need to deepen capital markets and reduce our dependence on imported capital through making KiwiSaver universal. It was our creation, and we think we need to follow those Australians and make it a universal work-based savings scheme. We need pro-growth tax reforms to ensure that that capital is invested in the right parts of the economy. So we've proposed a capital gains tax excluding the family home. Currently, I think we all know that overinvestment in property is rife. And a substantial driver of that is the tax bias which favours investment in land over other forms of investment. And that tax bias drives underinvestment in deposits in banks that might otherwise help fund you guys. It also drives underinvestment in productive plant and manufacturing equipment. The absence of a capital gains tax also pushes up house prices beyond the reach of many and enables some of New Zealand's wealthiest people to pay lower rates of tax than less wealthy New Zealanders, which is plainly unfair. It's worth noting that although this was until recently seen as a poison pill of politics to actually do what the OECD and the IMF and every other country in the developed world are part two, who are tax havens, it's worth noting that although that was the perceived wisdom, because we've actually taken on this challenge for the last over 3 years now and been pushing it, we've actually now got to the point that the majority of people in a reputable poll that was done by Fairfax Group this week, the majority of people now favour the introduction of a capital gains tax. We also need research and development tax credits, the second leg of our pro-growth tax reform, to encourage innovation and push our product mix towards higher value goods and services. As I've said, we need changes to monetary policy to have more attention paid to our overvalued and volatile currency, which currently hinders exporters and import substitutors. It's 25 years old now, the Reserve Bank. It's time to look at it again. None of these policy settings should be sacrosanct. I had the privilege of doing a study tour on monetary policy about a year ago, and I see I've got 7 minutes to go. Well, that's good, I won't take that long. And one of the people I met with was an expert at Harvard University, a guy called Professor Jeffrey Frankel, and he made 2 comments to me that rang true. He said, no one system of monetary policy is right for every country of the world, and no one system of monetary policy is right for any one country in the world all of the time. Those are 2 truisms that they struck a chord with me. And so in the Labour Party, it's another one of these status quo settings that we've been willing to challenge and say, look, we should be willing to address this given our history of a 30-year current account deficit and the role that the currency plays in that. I'm not wanting a currency that's falsely low, but neither do I think it should be held falsely high. So the policy challenge for us is to achieve a step change towards higher valued output as we move from volume to value that sustains higher income. And if we achieve this, we'll deliver societal well-being and maintain New Zealand's control of our destiny. Now, thankfully, from our perspective politically, this is actually becoming a more popular viewpoint in the public. And this change in viewpoint has come in no small part because of the global financial crisis laying bare frailties in economies which pushed financialisation of their economies too far, with inadequate investment in the productive sectors of their economy, leaving excessive reliance on service sectors. Now, pouring coffees and tucking in more tourists or selling more raw commodities, all of these jobs are dignified, but they don't add enough value to our productivity or sustain enough well-paid jobs in other parts of the economy in order to give our young people the future that they deserve. We do need to transfer more of our products and create additional value. The rest of the world sees this too, and so it's never going to be easy because the competition will always be tough. But the truth is, our exports haven't grown as a percentage of GDP. Our share of world trade has been dropping, and despite all the talk of added value over the last 30 years, we haven't grown middle New Zealand, we've shrunk it. Globalisation of the world trade accelerated exponentially in the 1980s. And I believe if you look back that you can see that we should have taken a decision back then that encouraged investment in sophisticated plant and innovation needed to improve labour productivity and sustain higher wages. But instead we took a different course in New Zealand. Savings were low and they stayed low. Monetary policy jacked up our exchange rate and interest rates, deterred productive investment, incentives for research and development went out the window, and tax policy continued to advantage speculation for capital gain over productive investment. The labour market remained slanted towards lower skilled jobs where people on low wages substituted for capital investment. Improvements in tertiary education were good. We've actually got a far better educated population than we had 20 or 30 years ago. But important though they are, they're no substitute for capital. And even with lower wages, we couldn't compete against developing countries when producing lower value, high labour content manufactured goods. Our failure to save and invest in sufficient new capital compounded. We didn't raise productivity, and so we fell further behind productivity improvements in other countries. So as a consequence, while there are exceptions, our productive export base has narrowed. Manufactured exports in New Zealand, outside of primary produce, which I don't think is enough for us, have declined 17% in the last 5 years. Now, if you think that we can make it on the back of a few more sheep and a bit more milk, maybe a bit more mining, then what I'm saying won't appeal to you. But if you have a view that we actually have to broaden the base of our exports and import substitution, then I think our history shows you have to agree that there's some changes needed to our economic settings in order to address these imbalances. They'll never be fixed if we restrict the debate to the status quo and doctrinaire slogans, mindless adherence to economic dogmas whose time have passed. Just as your industry has had to adapt to a swiftly changing market reality, albeit in this case brought about by massive natural catastrophe and some of the risks that showed in respect of replacement cover and the like, the nation has to adapt to a post-GFC reality. The sky will not fall in if we tax realised gains on investment property. It won't fall in if we back the tradable sector through monetary policy to move from volume to value, nor will it fail if Kiwi Assure enters the insurance market. As my former colleague Leanne so eloquently explained, the name of the game these days and the secret to long-term success is resilience. And I'm certain that the insurance industry is sufficiently resilient to meet the ongoing needs of a changing New Zealand and to play its role in that transformation. Thank you for your time.
Thank you, David. We've got time for a quick question or two. Have we? Anybody is?
There's a gentleman up the back left.
Gentleman at the back.
Leanne, I got a question.
A lot of running there. That's great. Hi, David. Thanks very much for coming today. It's great to see you again as well. I just want to ask you a question about Kiwi Assure. It seems like the premise is perhaps built on the fact that it's perceived that Kiwis aren't getting a good enough deal from the insurance market, if I'm reading that right from what I've heard. But I'd also like to know that the SME sector in New Zealand is huge. It's a huge part of our business environment. And you said that SME plant and machinery would be part of the Kiwi Assure offering. I'd like to kind of know what the definition of SME is under that, guys, and also what the keys to success would look like for Kiwi Assure from your perspective.
We've been trying to be careful not to insult the insurance industry by saying that they're dishonest or anything like that, or not trying to serve the New Zealand public well. And the closest we got to those sorts of insinuations, and they weren't intended as insinuations, was that a new competitor will keep them honest, which wasn't to imply that you're dishonest. As I said before, part of our motivation is to keep New Zealand Post and Kiwibank viable. Part of my motivation is also to have a New Zealand-owned competitor that isn't a drain on our current account. Very hard for a small insurer to start up these days, given capital requirements. Easier for the government to seed one through the likes of Kiwibank. So all those factors are in the mix. In terms of whether this is a natural progression, it was interesting that IAG's Commerce Commission application, when they sought approval to take over AMI, included the prediction that future competition would be coming from banks, and so the Commerce Commission ought not to be too concerned about further concentration of the insurance industry going to IAG. Lastly, your question about plant and equipment. I would have thought, and this will be a matter for the future directors of this new insurance company, I would have thought that they will be interested in the small business end of that rather than the larger SME end initially, because that reflects their existing lending book and personal account business mix of Kiwibank. So I would think it would reflect their existing business mix. Is there a problem there? Actually, I've been one of the people trying to win the by-election in Christchurch East, and I've encountered a number of people who can't get, for very small businesses, cover on plant and equipment. And I'm a wee bit surprised by that, sort of 2 years after the quake, after the last quake, 3 years after the first one. And so that's one of the reasons why we included plant and equipment.
It's covered by insurance, David.
Covered by insurance, my colleagues, yes.
Just a question over here, final question.
David, you mentioned making KiwiSaver compulsory. Have you thought about having compulsory third-party cover for motor vehicles as well? Because obviously part of the strain of the global financial crisis means that people are insuring less now than they used to.
We periodically consider that in the Labour Party, and there are always members of our caucus who think it's a good idea. I'm not quite so vexed by that as an issue. The largest cost in respect of motor vehicle accidents is the personal injury component, which is compulsorily covered through the ACC system. A requirement for compulsory third-party insurance, look, there would be some good side effects of it. There'd be fewer young guys in Subaru WRXs because their insurance premiums might be unaffordable, and that would have a societal benefit because we'd have a few less casualties on the road. But there'd also be distributional impacts from my perspective, in that some of the poorest people who don't pay insurance because they can't afford to would be forced to do so. So it's actually not something that I've got a